Hey guys, this is Muhab, and in this video we'll talk about 3 stocks that I bought in August and planning to buy more of throughout of September. So far, these stocks have been performing much better than the overall US market, and I'm expecting them to easily outperform the market in 3 to 5 years time. Before we talk about these stocks, as always, grab your cup of coffee, smash the like button, and let's roll the intro. First, I would like to start with the stock that has the most potential to easily 5x over the next 8 to 10 years, and that stock is Fiverr. In case you haven't heard of Fiverr, Fiverr is a website that offers a digital marketplace for a wide range of freelance services and helps businesses of different sizes find freelancers in over 200 different categories and across 8 verticals. Services that appears on companies' marketplace include graphic design, music and audio, programming and tech, video and animation, and much more. First of all, let's discuss the whole freelancing market and whether it's growing or not. Well, it's growing drastically. In 2019, the year-on-year revenue growth for freelancers grew by 78% in the US, 59% in the UK, and 48% in Brazil. In addition, as more people get laid off as a result of the pandemic, they lean towards freelancing more and more. Furthermore, millennials are nowadays leaning more towards working whenever they want and wherever they want, as they started to appreciate the value of time and changing location. However, according to Business Insider, more baby boomers are turning to freelancing to either earn extra income, bulk up retirement funds, or transition into retirement. More than 56 million American adults freelanced in 2018, and 30% of them were over the age of 55. All of that shows that we are yet to see the real value of freelancing. Fiverr is aiming to be the Amazon or Uber of freelance services, which is a big commitment but with a huge growth potential. When it comes to the company itself, it is even growing at a faster pace than the whole market. In Q2 of 2020, the company's revenue grew by an astounding 82% and active buyers grew by 28%. The company achieved quarterly adjusted EBITDA profitability for the first time in Fiverr's history and targeting adjusted EBITDA profitability for future quarters in 2020. This is very exciting news, as I was expecting the company to be profitable by at least 2021 or 2022, and now they're already profitable. Also, the company is hugely expanding to non-English countries and mainly European countries. Fiverr not only manages to add more categories and expand into new countries, but also they try to create a dedicated environment to connect freelancers with customers in the most convenient way. That happens through their Fiverr Pro and Fiverr Business programs. In Q1 of 2020, Fiverr expected a 36 to 38% revenue growth for the fiscal year of 2020. However, in Q2 of 2020, they updated that revenue forecast and now it is expected to grow 66 to 68% for the fiscal year of 2020. That's almost a double. In addition to the huge growth, the company has a gross profit margin of more than 80%. In addition, its gross profit margin barely changes despite its extreme strong growth. While, for example, a company like Delivery Hero, despite its strong growth, its cost of sales grew more than its revenue. That is not the case with Fiverr. In addition, Fiverr spends more than half of its gross profit on marketing, which means they can easily become profitable if they decided to cut a little bit on marketing. Furthermore, Fiverr has a current ratio of 2.5, which means it can very easily withstand any sudden changes in the market thanks to its huge pile of cash relative to its size and almost no debt. However, it's worth noting that Fiverr has a price to sales ratio of around 20, which is quite high. But judging from the addressable market and the competition, Fiverr could easily be a $20 billion company over the next 10 years, and I'm expecting it to be $30 to $40 billion company by 2030. Fiverr's current market cap is just under $4 billion, so that's 8 to 10x its current size. The closest competitor to Fiverr is Upwork, which, even though it has a price to sales ratio of 5, the website is hard to navigate, at least in my opinion. They're using the betting system, which is hectic for the buyer and massively reduces the profits for the sellers and the company too, and its growth is just around 20%, which is good. However, it's lower than Fiverr's growth of 66 to 68%. Finally, Upwork withdrew its forecast for the year 2020 as a result of the pandemic, and their growth seems to slow down, while as you can see for Fiverr, the growth is insanely high and it keeps on growing. With tens of millions of Americans unemployed in part because of the pandemic, many people are becoming freelancers to rebuild their income. It's a massive $750 billion market, of which Fiverr is currently targeting $100 billion in the US only. In turn, management sees an enormous opportunity for continued expansion. Next we got Adobe. Adobe is a software company that offers a line of solutions for individual and business customers worldwide. Adobe products include Photoshop, Illustrator, Premiere Pro, Experience Platform, and many more softwares that provide solutions. I've had my eyes on Adobe since it was $385 per share, and now it's around $425. Adobe isn't a cheap stock to buy. It's at an all-time high price to free cash flow, all-time high price to book ratio, and all-time high price to sales ratio. In addition, insiders has been lately selling the stock. However, all of the analysts according to Yahoo Finance and eToro rated the stock as a buy or hold. Despite its price being at an all-time high, the stock has a few eye-catching features that make it a great long-term growth stock to buy. First of all, the gross margin of Adobe is at 85%, which is really good. And if you don't know what a gross margin is, it is simply the revenue minus the cost of the revenue over the revenue itself. So if you sell a burger for $10 and it costs you $5 to make, then your gross profit margin is 50%, because $10 minus 5 is 5 and 5 over 10 is 0.5, which equates to 50%. For Adobe, it's 85%, which is considered high compared to other companies in general, and on average, the tech sector's profit margin is around 55%. So Adobe's gross profit margin is higher than the tech sector in general. Next, we got a great revenue growth history of more than 20% plus every year. Since the second quarter of 2015, so for around 5 years, the company's growth was higher than 20%, except for the last couple of quarters due to the pandemic. However, other than that, seeing a company of Adobe's size growing 20% plus consistently for more than 4 years is really good. If you have $10 and it kept on growing 20% yearly for 5 years, that'll be almost $25. So Adobe almost 2.5x their revenue in a couple of years, which also explains why the stock price grew 5x over the past 5 years. The price jumped from $79 per share to $473 per share. Insane growth in price and insane growth in revenue. It's also worth noting that Adobe improved its operating profit margin from 12% to 31% over the past 5 years, and that massively increased its net profit over the past couple of years. Despite its great history, the company has great growth potential in front of it too. Adobe's revenue is only 9% of its 2022 addressable market, which means it still has room for drastic growth. For example, when it comes to digital media, which is one of the sectors that they are pioneering in, they're only having 21% of the 2022 addressable market, so there's great growth there. In the digital media, it's only 9% of the 2022 addressable market. Again, great growth there. Same goes for digital experience, which they only have 4% of the market. Publishing, almost none of the market. They barely have any of the market. It's still a new sector for Adobe. And finally, the total revenue is just 9% of the whole addressable market. So when it comes to growth, if they could, for example, triple that, or maybe 4x that to make it 40%, or let's say 20, 25, 30%, that is great total revenue for Adobe. That's gonna triple their revenue, let's say, over the next 5, 6, 7, 8 years, which is still great, and I'm pretty sure that's gonna be much better than the overall market. According to Yahoo Finance, analysts are expecting that Adobe will achieve around 14% growth in 2020 and 15% growth in 2021, with a similar percentage increase for profits too. However, it's worth mentioning that over the last 2 years, Adobe has beaten earnings per share estimates 100% of the time, and has beaten revenue estimates 100% of the time too, and usually by a good margin. So Adobe achieving 18 to 20% growth in profits and maybe 16 to 17% growth in revenue could be easily achievable. In fact, in 2019, they achieved 24% year-over-year revenue growth and net income grew by 14% in that same period. And in the latest quarter, which is the second quarter of 2020, earnings increased by 26.8% and the revenue increased by 15.3% year over year. So despite Adobe's large size as a company, not only it is still growing massively, but it still has a lot of room for growth. So it's safe to say that Adobe's growth won't be stagnant anytime for at least the next 5 years. And I could even argue that it won't be less than a double-digit growth over the next 5 years. In addition to all of that, Adobe also has a huge recurring cash flow due to its subscriptions business model. Many people who subscribe to Adobe services like Photoshop or Adobe Premiere or any of its other services are people who will most likely keep their subscriptions in any circumstance, as they usually need it for their work or it's just something that they use on a regular basis. And even if the subscriber would like to buy or subscribe to a cheaper alternative, Adobe's brands are so strong that it's hard to find a good value for your money at a different company. Adobe's brands are so strong that people sometimes call photo editing as Photoshop. I personally don't see myself using anything other than Photoshop to make the thumbnails of my videos. The strong brands Adobe owns give them access to huge cash flow, which can be used to grow the company even more and buy back shares to boost up the stock price. Furthermore, Adobe is a moat and has a lot of optionality. But what does that mean? Well, being a moat means you have a sustainable competitive advantage, and when it comes to Adobe, that is its high switching costs. When you get used to an Adobe software, it's really hard to change because not only it's one of the top tier softwares and you may not find a better option elsewhere, but also because you got used to the software and you know how it works. And changing software will require you to learn everything all over again, which result into a high switching costs. And optionality means that the company has a lot of sources that can achieve their vision. Adobe wants to provide solutions to customers and businesses, and they can provide solutions using tons of products and services which will massively increase their revenue. They are not restricting themselves to any niche. The best example of a company with optionality is Amazon. They want to be the most customer-centric company, and they did that through Amazon Prime, Audible, Amazon FBA, Amazon Web Services, and many more. The sky is the limit. And same goes for Adobe. They can provide solutions through pretty much anything, and that means their potential growth is practically unlimited. Lately, Adobe is working to make its creative products more accessible to non-career creatives, which it calls consumers and communicators. Mobile-only apps, template-driven content design, and lower-priced subscriptions like the $9.99 photography plan are efforts to appeal to this customer set, which makes up more than half of the addressable market for its Creative Cloud products. Addressing casual customers and convincing them to subscribe to Adobe's services will open a huge door of revenue to Adobe. When it comes to Adobe stock, I am not expecting it to grow as much as Fiverr. However, it's one of those stocks that I can have in my portfolio and not worry about at all. Is Adobe a pricey stock? Absolutely. Is it worth its premium price? In my opinion, yes. Finally, we got the last stock I am buying in the month of September, which is Intuitive Surgical. Intuitive Surgical has very similar properties to Adobe stock. It is the type of stock that is premiumly priced, not expected to 5x or 10x in a couple of years, but the type of stock that will most probably beat the market safely and steadily. Don't get me wrong, the stock upper line is growing by a double digit and the company is massively growing. However, it is so dominant and known in the market that a good portion of its growth is already priced in. I talked in detail why I think this stock is a great buy in the video where I reviewed my whole portfolio. If you would like to see my review of Intuitive Surgical stock in detail and my review of my whole portfolio at the time, just click on the card in front of you to watch that video. If you would like to see the stocks I currently hold, I'll make sure to leave the link to my portfolio in the description below, and to see it, it will just cost you a like for this video. Alright guys, that's the end of the video. If you have any questions, make sure to write them in the comments below and I'll try to reply to them as soon as possible. Please don't forget to like, share and subscribe. This is Muhab and I am signing out.